I'm going to be honest with you. I don't have good news when it comes to markets and the economy. Now, if you've listened to the Gains podcast, hopefully you're in some of the areas that have done well as of late. And, we've kind of smelled out some of the stuff that's happened here. But I really don't have good news. I mean, the Dow theory has gone bearish. You take a technical look at the market, it isn't good, at least for the short term, which then could pose opportunities. But the news certainly isn't good, and there's a lot of ugly we're going to discuss today. But hey, we're going to deliver the truth, and that's fair, right? I'm Andy Gersher, and this is Gains. Let's bring on Jim Welsh, macro strategist and portfolio manager at Smart Portfolios out of San Diego. His website, as always, macrotides.com. Hey, Jim, always great to have you on the Gains podcast. Things have gotten even more tense and markets look even more shaky than the last time we talked.
They do, and it's kind of like we're getting doubled up here. Obviously, the Ukraine war is a big deal, but the markets can't draw any comfort from the prospect that the Federal Reserve might ease off and not raise rates in the next handful of months because of the war. The reality is just the opposite. As we saw with the very high CPI number today, the Fed really doesn't have a choice, Andy. They're so far behind the curve because they stuck to the script of, inflation is going to be transitory last year. And then when they started to move, they really were very timid in terms of slowing the amount of purchases and so forth. So I don't think they have a choice in raising rates at the March meeting. And when Chair Powell testified last week in front of Congress, he opened the door to 50 basis point increases at potentially some future meeting. So I think that's the rock and hard place that the market finds itself in, is we have two good reasons to sell, and it's hard to come up with any good reason as to why someone would want to buy right here and right now.
It is crazy. And, the other thing, too, is everything now is getting pushed to, it's Russia, Ukraine. But, Jim, you and I have been talking about this for a very long time. There's so much more on the economic front domestically that is the true driver of markets to the downside. As horrible as it is to see pictures on television and the Russian invasion of Ukraine, and we've seen the energy thing, which, by the way, in that recent CPI number hasn't even been baked in yet. We could talk about that. But there are sources out there that are citing, the high energy prices, this really high inflation, it all has to do with Russia and Ukraine. That's not the case at all. Explain why that's not. Yeah.
Well, again, every administration struggles, Andy, to acknowledge that policy errors were made along the way. And
not only the administration, but even at the Federal Reserve level.
Yeah, I mean, for sure. Now, to Powell's credit, he did acknowledge that in the last month or so that the Fed got it wrong. They thought it was going to be transitory. Turned out it wasn't correct. So he deserves some credit for that. It unfortunately doesn't change the reality.
And then the other thing is, Jim, he should have listened to the Gains podcast. That's because that's what we were talking about even around Thanksgiving, that he was wrong.
Yeah. Well, I started writing it actually in my monthly macro tides, Andy, like last July, because there were so many signs that things just weren't improving, supply chain, computer chips, labor market tightness, and so forth, that there was no sign of improvement.
But did the Fed get clouded by politics?
I think what Powell has kind of come across, as you might remember, August of 2020, they adopted average inflation targeting. And the idea was we want inflation to average 2% over a complete business cycle, meaning both the expansion and then recession. What that indicated was that the Fed would tolerate, near the end of an expansion, inflation above 2%, knowing that it would then subsequently drop below 2%. The Fed kept policy easy in 2018 and 19. And Powell has noted numerous times that one of the benefits of allowing the economy to theoretically run hot was that the unemployment rate was low, inflation didn't pick up, but more importantly, lower income workers' wages went up faster than every other category. So for him, that was a great benefit. And I think in January, he made a comment that we would love to get back to 2018 and 19. And I think that's an important comment to remember, because I believe that behind the rhetoric and tough talk that the Fed has to say at this point in time, that 6-9 months from now, if and when inflation does start to come down, and looks like it has, further to come down, and you're going to need supply chain improvement, computer chips, and so forth, that the underlying belief that Powell has is, if we can, let's let the economy run a little stronger so that we can see more income gains accrue to lower income people. So that has become, I think, a tenet of his philosophy in terms of approachment to monetary policy.
Just the opposite happened, by the way. Some of the poorest folks are by taking that policy and doing what they're doing, they've actually hurt some of the poorest people in the country too, on top of that.
Absolutely. I mean, again, what happened here, and some of this is definitely the Fed's doing, then the government, and this is something that the administration continues to not acknowledge, that last year in March, when they passed the $1.9 trillion American Rescue Plan, it was way past the time that anybody really needed rescuing. The economy was on recovery path. Vaccinations were moving along as fast as they could. And the government basically gave a lot of money to people who already had a job. They just poured money into it. So if you look at what happened to the supply chain, it was only after they dumped all that extra money into the system where the supply chain all of a sudden got, bottled up more than it had been. So it's not the only reason for any of these things, and I'm not trying to suggest that, but it did contribute to a big increase in demand at a time where people were a little reluctant to go back to work because of Omicron and Delta last year. And so you had this imbalance created between supply and demand, where supply was being held down by COVID and some other factors, and demand was being goosed by all the government money that was sent out. Let's not forget, the federal government handed out $6 trillion in about 18 months. That's 30% of GDP. So not to acknowledge that we might have overdone it is impossible for them, because, in fact, they would like to spend another $3 trillion.
I was just going to say that. They're talking about printing even more money. And, Economics 101, I mean, when you increase the money supply on a limited amount of goods, hence inflation. So, we've talked about how you and I have in the past talked about the energy missteps, just unbelievable on so many levels. And then we've talked about the Fed totally misplaying this. And we've talked about, it's going to be transitory, even though you and I have been talking about it for 6 months. You even been writing about it even longer, that it wouldn't be transitory. And then you've just kind of talked about money printing in all of this. So, again, these are all things that have nothing. Well, the recent jump in oil, Russia and Ukraine.
Okay, about energy and what happened and all this. And the administration is going out of its way now to blame inflation on both, obviously, the Ukraine war. And the other theme that has been developing really over the last month or two is it's due to greedy corporations raising prices and taking advantage of people. Oh,
that's another rich one we've heard recently. Oh, the greedy oil companies.
Yeah. Well, and, meat companies.
Oh, yes, that was another one.
Biden is investigating them. If you look at meat prices for the last 5 years, for 3 of those years prior to the pandemic, meat prices barely budged. And it was only in response to the pandemic, labor shortages, people at home eating more meals at home and so forth, that really drove prices up. Elizabeth Warren made a comment about how profit margins are going up. Well, the reality is that, most companies have kind of like fixed costs. You've got your labor, you've got cost of goods, you've got taxes, of course. And if all of a sudden people want more of your products, your revenue is going to increase. So that for each dollar of revenue before that increase, maybe you're making, like, the average oil company, most people don't know this, out of every dollar of sales makes 9 cents. The average manufacturing company in this country historically has made 5 cents out of every dollar of sale, whereas Apple and other technology companies are like 25 to 30 cents. But nobody minds Apple ripping them off. But, oh, my gosh, let's have an investigation because gasoline prices went up. So my point, though, is Elizabeth Warren completely overlooks or misunderstands, or both intentionally, that if your sales go up because of demand, more of the revenue is going to flow to the bottom line because your cost basis is mostly fixed. And so that's a natural. You don't even have to raise prices. All of a sudden, demand jumps by 10%, and revenue goes from $1 to $1.10, and you were making 9 cents for every dollar. Guess what? On $1.10 of sales, you're going to make more profits. So, but this is convenient to deflect, and most people in this country, unfortunately, don't get almost none in terms of education, in terms of understanding how the economy works and functions. I mean, I've asked people, how much of every dollar of sales do you think the oil company makes? And most people guess 40, 50 cents. It's 9 cents, okay?
Right.
So,
and the grocery business, by the way, too, is a really, really tight margin business, too. The meat business isn't a super highly 1%. Profitable business. So we've talked about, I mean, obviously there's missteps and then a ton of blame that's gone around. Yeah. And so now that's where we're at. And we talk to you often, Jim, about where the market is technically. So we're going to, we've talked about these missteps and some of the bad calls and some of the missteps from the Fed and other parties involved. Now, set the table, explain where the market's at and why there's some problems.
Yeah, well, most investors, especially institutional investors, are long-term focused. In other words, they're looking out 3 to 5 years. And most of the time that works pretty well, Andy, because over a longer period of time, the market has historically trended up since 1932. Between 2009 and 2020, we had a 10-year business expansion. The market kept moving higher. But what happened in 2000, what happened in 2007 is that you get to a place where events develop that then threaten to push the economy into a recession. Over the last 50, 60 years, the average decline in the S&P when a recession develops is 36%. When you're not in a recession, the average decline is 15%. So that's, if you will, the big dividing line between are you going into a recession or not. And I think with the Ukraine war, what's happening with energy, and the other side thing that's going to develop over the next 6 to 12 months is the cost of food is going to continue to ramp up. I wrote about this in December in terms of the cost of fertilizer, which is used in obviously planting every crop there is. And the cost already had gone up significantly. To that original question, oil had gone from $40 to $90 in December before any talk of real serious talk and risk of Russia going into Ukraine. So, a lot of the energy inflation took place already. My point about the food, though, is food costs are going to continue to rise. And what's going to happen to a lot of poor countries around the world, like Egypt, they import 80 to 90% of their wheat. And look at what happened to wheat prices. In 2011, the Arab Spring uprising happened because of high food prices. So I'm afraid that a year from now, we're going to see articles, Andy, that talk about millions and tens of millions of people that are approaching starvation because there isn't enough food. And with the high cost of fertilizer, and a lot of countries, they just simply can't afford to use the same amount of fertilizer. They will plant less. The crop levels for corn and wheat will go down. And the same thing is going to affect U.S. farmers to a lesser extent. So my point is, you go out a year from now or so, we're going to see shortages of more and more foods. And until all this resolves itself, you always have to wait until the next planting season to correct this problem. So to me, we're talking about energy right now, but I think down the road we're going to be talking about food. And it's going to be serious for a lot of underdeveloped nations around the world. So that, to me, is the next kind of shoe to drop. And we're going to see food prices, as I said, in the U.S. to continue to march higher because of this imbalance that's developed. And the cost of energy, how it feeds into fertilizer, which then is a big cost in producing food grain.
All right, so that's, the economy, conditions on the ground. I made kind of a point earlier. We had CPI, Consumer Price Index data today was running super, super hot. And the interesting thing is that was from February, and that's not even, factoring in the latest jump in oil prices. So with with that economic and geopolitical and everything going on in the background, from from a technical standpoint, let's hit on some levels. Tell the Gaines listeners, what levels you're watching right now and the downside that you see. Yeah,
my view, was when the S&P got to 42.23, January 24th, we were going to get a bounce, then drop below that. The S&P got down to 41.15, I believe, on February 24th. Then we got a bounce. I think the S&P is going to drop below 41.15, and I think the next time we see a close below 4,200, I think it could open up a floodgate where we see kind of like the market's been finding this area of 4,200-ish as support, and it keeps trying to bounce off of it. The bounces keep getting weaker, and normally that then leads to a flush out. From the low in March of 2020, the S&P bottomed at 2192. The high in January of this year was 4818. One of the computations that I use is, how big of a pullback based on the length of that rally can we expect? The 38.2% retracement is 3815. So I think that's our risk, over the next handful of weeks, potentially. So I believe we're going to go below 4115. I think the odds are the S&P will drop below 4,000, and I think this all could happen by the end of March.
And if this plays out, do you even see farther out even more downside? I know you look more on the short term, but as this is shaping up, is there even more pressure beyond that down the road?
Yes. Up until the last couple of weeks, I thought there was a very low probability that the U.S. economy would go into a recession. Obviously, the dislocation with energy prices is going to hit lower income people. But that in and of itself isn't enough to derail the U.S. economy, because if you compare how much energy is used today compared to the late 1970s when the oil embargo occurred, we're far less energy concentration than we were then. The thing that I think makes this different, though, is when all of us turn on our TV at night or during the day and you see what's going on in Ukraine, and now we've got an individual who has actually, I'm lighting up my nukes and so forth. I think for most of us, we view what's going on, and you go to, fill up your car, you go to the grocery store. It's hard not to have a small sense of, man, things seem to be like spinning out of control. And when that happens, I think the natural instinct for most people is to pull back. So to me, the greater risk for the economy, Andy, is that over the next month or so, as long as this stuff persists, we're going to see the majority of Americans pull back a little bit, not because they have to, just because they feel so unsettled by the uncertainty they're watching and all the rest of it. So the risk of a recession has increased, I think, a fair amount. I still don't think we're going to have a recession, but one has to respect it. Technically, I have a proprietary indicator I call the major trend indicator, and it's intended to identify bull phases and bear phases. In the last few days, it gave a bear market warning signal. So that obviously increases the risk of a bear market. Normally what has happened in the past, like during the 2000 to 2003 bear market, 2007 to 2009 bear market, it'll drop into, if you will, bear market territory. The market will be very oversold. It'll have a multi-week rally from 6 to 12 weeks. the major trend indicator will turn up. But if it doesn't get back above the bull market threshold and instead tops before it gets there and rolls over, that's when it provides a confirmed bear market signal. So the next rally is going to be critical, because if it generates a bear market confirmation signal, my assumption, Andy, is that, okay, the risk of us going into a recession has just also ramped up. My expectation is we get to somewhere between 3,800, 4,000 on the S&P. I think there's going to be a fairly decent rebound at some point in time. And then what happens next is going to, I think, tell us a lot about what to expect over the next the balance of this year. So a month ago I thought, okay, we're going to get a 10 to 15% correction. When you and I spoke in December, my outlook was for a 10 to 15% correction as the market backed off as the Fed changed monetary policy. That's exactly what we got. Obviously, the Ukraine war has added on top of that a completely different problem, and one has to kind of adapt to what's happening. So if somebody's throwing a fastball at your head, you don't think about it, you duck. So to me, that we're being presented with a completely different set of circumstances than 4 to 6 weeks ago. We've gotten a 10 to 15% correction, but I think the risk of a bear market has undoubtedly increased, and that has to be respected.
A lot of us in the Gains Nation also follow the Dow theory, which is bearish right now. We're going to take a quick break here. So as always, be sure to subscribe, follow, and leave us a 5-star review on Apple Podcasts, if that's an option for you. And as always, subscribe and turn on those notifications so you know when a new episode drops. We drop Gains episodes on Tuesday and Thursday afternoons. We are back on Tuesday. We are going to do a 101 and take a deep dive on NFTs, non-fungible tokens. So you'll definitely want to check that out on the Gains podcast next Tuesday. Okay, we're going to take a quick break, and we will be right back.
If you enjoy learning about communities, culture, and history, then Shades of the City podcast is for you. We will bring you stories like the legacy of Johnston Publishing Company, most notably known for Jet and Ebony magazines.
Basically, what the world said African American people could not do, these magazines proved otherwise.
Subscribe now to Shades of the City on the Odyssey app, Apple Podcasts, or wherever you get your podcasts.
Back with Jim Welsh, macro strategist and portfolio manager at Smart Portfolios in San Diego. And his website is always macrotides.com. As we were going into the break, we were doing plugs. Jim, go ahead and give us your plugs. You often also share an email that our Gains listeners can ask questions, that kind of thing. So, go ahead and give us your plugs today.
Sure. Well, if you would like to receive the last weekly technical review from this past Monday, send me an email, Jim Welsh, WELSH, macro, MACRO, at gmail.com, and I will send that out to you. And you can also get additional information at my website, macrotides.com.
All right, we wanted to talk about a couple plays here, a couple things that we've talked about in the past that have worked, and I wanted to kind of see where you're at. A lot of the Gains listeners, we talked a while back and talked about how oil was going to probably have a good run. I think that we probably didn't see it quite like this, not quite this high, but for us who got in on some of the big oil, some of the pipelines, some of the oil transportation aspects, some of the stocks that we bought and in the energy space have done really, really well, especially compared to the rest of the market. Full disclosure, I'm starting to unwind some of those positions because I think that we've come a long way, and I'd like to lock in some gains and then maybe even save that dry powder for some sales that we maybe foresee coming. Where with that oil run up, Seems like we're getting a little close to at least a top. And like I said, I've been kind of unloading on some stuff that I've made money on. What's your take on that?
I think you're being prudent from a standpoint when things have huge gains in a short amount of time. You got to start selling a third or some percentage. And then the other issue is using chart analysis to be able to look at the past history of any instrument that you're invested in to see where a top may form, or in this case, you had a spike up, and then be able to identify stop loss areas so that you're not giving up too much of your gains because the market reverses pretty quickly. And we kind of got a hint of that yesterday when a story about the UAE increasing production. I think there's going to be an increase in production from a number of sources in the psychology that has been driving the oil market. This last little bit, I think there's a measure of speculation taking place, Andy, and you get a hint of any real supply starting to show up. And that's the part that's going to unwind pretty quickly. So I think you're prudent to sell into some of the strength that we've seen, because at a minimum, my guess is there's going to be a consolidation where all of a sudden oil stocks will trade in a range. It might be a 7 or 8% sideways range from top to bottom, but I think that's likely because there's going to be other people who will do some selling into strength. So that starts to cap the upside in the near term. And then there's people who missed out on the move, and they're going to want to buy on a pullback. So that's how you get a range after a big up move, is you've got two parties, one looking to cash in some profits, and the other one, hey, I want to buy some more on a pullback, or I want to at least buy something on a pullback. And that's what I think is the most likely outcome, is that there's going to be a trading range in most of the energy issues.
They always say, the cure for a low energy supply and higher prices is higher prices, because there's incentive to go get this stuff. So, so is that what you're kind of doing too? Have you done well in some of the oil area?
Andy, the last time we talked, or maybe it was 2 times ago, I talked about a chart, a trend line that came in about $90 a barrel on oil.
Right.
You said, no, I think Putin's going in. And I'm like, well, unless oil breaks out above this trend line, and I didn't think it would happen, to me, I'm looking at that chart as indicating that Putin is not going to go in, and we'll see a pullback. I was wrong about that, because in my mind, I just don't see the upside. That Ukraine is not going to willingly allow Putin to stay, if you will. I don't think he's turning back. And this brings up an interesting thing I've been thinking about the last couple of days. Mutually assured destruction. That was something that the world kind of got to, where the two major nuclear powers sat down, looked across the table at each other and said, you know what, you've got enough nuclear weapons to wipe me out, and I've got enough weapons to wipe you out, and therefore it's kind of stupid for us to play that game. It makes no sense. And the world found an equilibrium point based on mutually assured destruction. I think that calculus has changed, because now we look at a guy like Putin, and all of a sudden, gee, it seems like he very well might be willing to play with nuclear weapons.
Or he wants you to think that.
Yeah. Well, the reality is he makes that statement, and he immediately sees the West recoil. And, okay, we got to avoid triggering that type of a thing, understandably, okay? But that's his calculus, is that I can intimidate people because they're going to perceive me as being willing to use tactical nuclear weapons, and they don't want that to happen.
That's why you never cower to, when you're on the playground, you never cower to a bully. In fact, you're better off going out swinging. And if they say something, you got to counter. You just kind of spoke to that. That cowering is dangerous in itself.
Well, again, I think for Putin, he looked at how really stupid Germany has been in terms of making itself and putting itself in a position to be importing 40% of its natural gas from Russia and decommissioning nuclear power plants. And so I think he really looks down on Western leaders. He saw how, President Obama drew a red line in Syria, never did anything about it. He saw how President Biden pulled out of Afghanistan. And so they, guys like Putin look at things, okay, is there weakness there? And I think this is setting a precedent in that China, looking at Taiwan, at some point in time down the road, they may look at it and say, you know what, all we have to do is threaten using nuclear weapons, and they will back off. And that, I think, is the precedent that Putin is establishing here, that he's threatening, and for the first time, maybe ever, there's enough people think, this guy might actually be willing to do that. And so the whole dynamic to me has changed going forward. And I'm not sure it changes unless, somehow Putin has a heart attack along with the top 5 or 10 generals. Because I don't believe there are no amount of sanctions that will get Putin to leave Ukraine. And, Putin is controlling what everyone hears in Russia, that this is a war of peace, that they're liberating Ukraine, and the West is just picking on us and so forth. So the majority of people in Russia, this is certainly true of the older Russians, believe that he's doing something good because they're not hearing any other information. He's basically told Western journalists, you say anything other than that this is a peace mission, and you're going to jail.
Welcome to war propaganda, too, though.
Yeah.
And there's a ton of it going around.
It's a whole different ballgame, I think, that what we're witnessing. And it's hard not to be obviously concerned.
Other areas, we often talk about uranium. Yep. One of the plays that I've been kind of playing with, thanks to you, is that Global X Uranium ETF, and the ticker's URA. We've seen a lot of volatility in that, and a lot of and that thing has spiked as of late as well. What are you doing with your uranium position?
I'm holding it. My expectation was that uranium would rally back up to the high from last November, which was above $31 a share. My expectation is that uranium is going to rally back up to that level, and then we'll see what happens next. Does it break through and keep going, or, you just take it in from there? But right now the chart looks like it's going above $31 a share. And, the world is coming around. Even Germany, or Europe, I should say, a number of weeks ago came out and said, yeah, we're going to have a little different view on nuclear power. And I think that's more and more countries are going to, I think, come around to realizing that renewables are important, but you need something that's going to provide stable, clean energy. And the reality is, Andy, I read a piece about a week ago that if you look at the amount of energy that a nuclear power plant generates, and you say, okay, we're going to generate an equivalent amount of energy from solar panels. Well, you're going to use 450 times the amount of land. What that means, you have to clear it of every single insect, animal, and so forth. You'll use 17 times the amount of materials, cement and steel and everything else, as you would in a nuclear power plant. Most, I think, environmentalists aren't aware at all that there's any serious downside to some of these choices. So I'm hoping that more and more people realize that in today's day and age, that nuclear is a real option. Elon Musk, I think last weekend, came out and said, hey, we need to look at nuclear. Germany should extend its 3 plants and so forth. And I looked at his feed, and so many people were attacking the guy. And one guy made a comment about, yeah, look at Chernobyl. And it's like, are you kidding me? That was at the very end of the Soviet Union. And we're talking about technology that Russia had, which is nowhere near the kind of technology that we could come to bear in 2022. So, I just think that there's a lot of people that just are so anti-nuclear that no matter what information and facts you give them, they're just not going to listen.
Chernobyl was 1986, by the way. I mean, that's a long time ago. I mean, it's like saying I feel uncomfortable riding on a Wright Flyer when I'm flying on an airplane.
Yeah.
I mean,
most people have more technology in the watch around the wrist than the lunar module did when it landed on the moon in 1969.
Yeah, there's something to be said for 20, 30, 40 years of technological advances.
Yeah. So anyway, I think potentially uranium has a real future as a choice. And, so at a minimum, I think from a trading standpoint, a move up towards 31 seems likely. And again, this is not necessarily for the faint of heart. There's a lot of volatility in this thing. It can move 3-4% in a day fairly frequently, and that may not be appropriate for a lot of people's temperament.
But for the Gaines listener, that gives us the juice that
right up there,
that we're looking for, right? Here's the one thing, and I've talked to a number of people about this. Usually when, you have some area you can invest in, but right now it is very limited. Everything is kind of getting clocked unless you've been in energy or you've outright shorted the market. But and I think for a lot of investors, there's concern that, okay, your investments are getting hit, and this comes at the same time that if you just sit with dry powder, the inflation is running kind of hot, that your dry powder is slowly losing its purchasing power as well. So how do you do that, or how do you navigate that as an investor? There's very limited places to get cover in this kind of scenario.
Well, you're right, but it comes down to the lesser evil. And so to me, sitting and having cash, waiting for an opportunity to develop, you may be losing some ground to inflation at this point in time, but I think that's far superior than putting money in the market and losing 10% or 15% or 30 or 40%. And a lot of stocks are down way more than the S&P. So the damage is more broad and deeper than what the S&P reflects. So to me, this is one of those environments where if the bear market is about to develop, cash is a wonderful investment, irrespective of the erosion of purchasing power from inflation. It's much better to still have a dollar minus 3 or 4% due to inflation, as opposed to being down 10, 30, or 40%.
Right, that dollar being worth 30 cents. Yeah.
So, again, in terms of gains, listeners, and so forth, I talked about the major trend indicator. If we get a rally that lasts 6 to 12 weeks, and the major trend indicator does not signal a new bull market, and instead rolls over and signals a bear market, that is a sell short signal with that methodology. So I thought we were going to have a 10 to 15% correction. It was based on the assumption that, the Fed's going to change monetary policy, but the economy is not going to go into recession. Now we do have to recognize, at least, the risk of a recession is going higher. Again, if we get a rally, the major trend indicator indicates a sell short signal, then that to me will be the signal to say, okay, time to go short. As I mentioned earlier, average decline in a bear market is 36%, and just because if the signal came with the S&P down 10% or 8%, potentially you're looking at a big gain in terms of subsequent losses as the economy weakens. I mean, again, what's happening here, Andy, is rates are going up on Treasury yields. I mean, this is the other thing, to your point. Most people have a 60-40 portfolio, 60% stocks, 40 bonds. That's the classic, right? Well, historically, what's happened is the stock market goes down and the bond portion would go up, particularly treasuries and high-grade corporates. What's happening this time, and I wrote about this 2 years ago, that we're coming to a point where bonds and stocks would sell off together. Because during the 50s and 60s and 70s and early 80s, that's what happened. It wasn't until 2000, that bear market, where bonds really provided ballast so that, I lost 40% on my equity side, but bonds were up 10%. That's not what's happening now. So what's happening is most people, if they have a balanced portfolio, they're losing both on the stock side and on the bond side. So again, cash, looks much more attractive relative to, that situation. It's providing real ballast for portfolios right now.
This is probably one of the first money conversations I've had, extended money conversations I've had in 2 years without bringing up COVID. I mean, it's kind of funny. I mean,
Yeah.
in all of this, COVID's really moved down the list of concerns, and the way this stuff is kind of spreading, and the cases have dropped.
Yeah.
It doesn't seem as deadly. It's really moved to the back burner. I mean, the fear of COVID and that economic impact is all but pretty much gone now.
Yes. Yeah. Now, again, the risk here is that when we get to the heat of the summer months, July and August, because that's what's been happening the last couple of years, as people move indoors because of air conditioning in the south and even northeast, as the temperature really climbs, that's when we're more vulnerable to another variant or a breakout. So to me, that's going to be the next hurdle. But you're 100% right, Andy. It's way down the list of threats at this point in time relative to, obviously, the Ukraine war and monetary policy.
And hopefully this kind of a COVID kind of follows what happened 100 years ago. Going in after that second year, there were variants that basically killed it out of existence, and then it disappeared. So at least, by the numbers and everything that we've seen, we're at least headed in the right direction for now. One other thing real quick, and then I'll have you give us your parting shots.
Yep.
One area that has done well when markets get crushed in the past, and we're starting to see it peak up a little bit now, is precious metals, especially gold. Silver, not so much. Silver's kind of been laying flat, but we've seen a little uptick in gold. Where are you with the precious metal trade? That is one that's often brought in when there is uncertainty and this kind of thing.
Yeah, gold broke out when it got above 1920. That was, to me, a very important level, and obviously quickly ran up to 2070. I think there's a chance that gold will pull back towards the 1960 level. So to me, what I'm looking for is pullbacks in gold and the gold stocks. GDX pulling back below 3650. It might get nearer to 3550 because I think the breakout signals that we're going to see higher prices in gold and then the gold stocks following throughout this year. So what that implies is gold potentially then breaks out above 2070. And if it does that, then you're probably talking 2220, 2240, something like that. So I don't like to chase things. It's not usually a good policy. Gold traded up to 2070, and I think it traded to 1983 within really one trading day. So I'm looking to buy on a pullback in both gold and the gold stocks to the levels that I just mentioned.
And you usually get a little bit more bang for the buck, it seems like, in those gold stocks.
Absolutely. When they come to life, they can motor. 2 to 3 times whatever the metal does, you can get that performance out of the gold stocks.
Give us your favorite one. You've shared it with our audience in the past. Give us that ticker.
GDX is the gold stocks, and I use IAU, which is instead of GLD. I think for most people it's more within the reach. GLD is $186, IAU's $38. So it makes it easier for people to, I think, manage the positions with an ETF that's lower priced, IAU relative to the GLD.
I'm looking for the bigger bang, so I'd go with the GDX when I'm going with the exposure.
Oh, yeah. I mean, and if you want to go a step further, then you do the juniors, GDXJ. So
yes.
That one has even more volatility.
Say that one again,
than
Jim.
GDXJ for juniors.
For juniors, GDXJ. I'm going to definitely check that out. As we're wrapping up today's Gains podcast, and we've covered a lot of ground, and there's not a lot of happy things to talk about here, but obviously we're going to have to let this kind of play out. What's your parting shots as far as today's conversation?
Well, again, I think the market... again, if we look at the low in 2018 in December for the stock market and then March of 2020, both those lows were kind of made possible because the Fed did a pivot on monetary policy from, to aggressive easing, especially March of 2020. We then saw on top of March of 2020 fiscal stimulus. That's not going to happen this time. So the market is going to have to get flushed out one thing I didn't mention earlier is there has yet to be a 90% down day. And by that I mean if a billion shares get traded on the New York Stock Exchange, that 900 million, 90% of them are down volume. We haven't gotten that. Now, a lot of times lows are associated with that kind of a flush.
Is that a sign of capitulation at the bottom there?
You're spot on. That's exactly what it is when people throw in the towel. And what we've seen over the last month, obviously people have been able to jump on energy, and it's worked well. For a while they tried financials, and that kind of soured. Precious metals the last couple of weeks. So capitulation means they just throw everything out, and I think there's the risk, especially if the S&P closes below 4,200. If it's going to make its way down to that 3815 potential target, you're going to see a capitulation day when that happens. And I think that's a shoe to drop. The other issue, if you look at the VIX, after the low in March of 2020, Andy, we'd have sell-offs and the VIX would spike for about 3, 4, 5 days and immediately come down. If you look at over the last 6 weeks, the VIX has just been grinding higher and higher and higher. So the character of this decline is completely different. And again, I think it relates to the fact that investors have two fairly significant reasons not to want to be a buyer and potentially be sellers because they're worried about a recession developing in the next, before the end of this year. So that to me is the problem. You need a reason to buy, and right now we have more readily reasons to sell.
All right, so we're going to have to let this play out a little bit, and then certainly, as always, we bring you on all the time, so we'll be talking. Yeah, we'll be talking, and hey, thanks for your honesty and your assessment here, because our discussion, I'd like to think, has saved some people some money as, the end of last year, taking some chips off the table and then moving into some of these other areas that have actually held up fairly well. So a lot of credit to you, Jim, on that one.
Well, sometimes, again, I believe in chart analysis, Andy, and every investor who listens to this should really get a book about technical analysis and begin to kind of bone up on it. It may take you 3 to 5 years, but it is indispensable, I think, when you couple technical analysis with fundamental analysis. Now you're getting the whole picture, and a lot of times technical analysis is a much stronger risk management tool, both telling you when you're right and, more importantly, telling you when you're wrong. And
those charts have really given us insight to where we are right now, and that's a great thing. And that kind of just, puts an exclamation mark on your point. Learn technical analysis, because it can give you a whiff of maybe downside if it comes, or the potential of upside. All right, Jim, hey, as I'm wrapping up here, as always, you're, macro strategist and portfolio manager at Smart Portfolios in San Diego, and your website, macrotides.com. And then you always are happy to share your insight specifically with the Gains listeners. Give that final plug before we wrap up.
Sure. Send me an email, jimwelshmacro@gmail.com, and I'll send you last week's weekly technical review. Just as an aside, I got an inquiry a couple of days ago, sent the last Monday's weekly technical review to a fella, and he wrote me back this morning. He said, I was kind of thinking the market was going to be okay, but after I read your letter, I changed positions, and I made $7,000 this morning.
That's what I want to hear. That's what I want to hear. You can make money in markets regardless of the direction if you chart it and of course, have a little luck.
Never hurts to have the leprechaun on your shoulder.
Yeah. So by the way, speaking of leprechauns, it's St. Patrick's Day weekend in Chicago. We haven't had a good one for darn 2 years now. So
enjoy.
On that note, and a lot of people probably don't even know this, but Jim is a Chicagoan. He was born in Chicago, so
south side of Chicago, and went to St. Ignatius High School, and hey, I always will love Chicago. It's a great town,
especially come St. Patrick's Day. Well, hey, always appreciate it, Jim.
You're welcome. Thank you.
All right, that's going to wrap up the Gains podcast. As always, thanks for joining us. Be sure to subscribe, follow, leave us a 5-star review on Apple Podcasts. And then, as always, subscribe and turn on those notifications so you know when a new episode drops. We are back on Tuesday, and we're going to take a deep dive into NFTs, non-fungible tokens. And by the way, if you have any questions, I'll give you my email real quick here. It's andy.gersher@odyssey.com. And again, that's andy.gersher@odyssey, AUDACY.com. So if you have any questions, hit me up with an email. But like I said, a lot of people have been asking me about NFTs, non-fungible tokens, and we are going to take a deep dive next Tuesday on the Gains podcast. So you're going to want to check it out. There's a ton of opportunities in NFTs going forward. See you on Tuesday.
A News Radio WBBM podcast powered by Odyssey.